Regional banking in the United States has been a huge highlight for liquidity and maybe something that could be widespread. So let's understand exactly what's happening and the true dangers of what could happen to liquidity and, of course, to the markets and Bitcoin. So, first off, we're talking about mostly Zions and Western Alliance banks, which are community banks, and these are extremely important to the United States since it provides a way to distribute capital within the Fed, the regulated system in the U.S. So most people are not aware, but the U.S. has hundreds of thousands of different institutions of banks called community banks, which are very small ones that know exactly what is happening locally. They know their clients. They have some relationship built throughout the years. And those banks are actually getting in a situation where they just absorbed by larger conglomerates. So the amount of institutions is actually shrinking, which is a problem when you want to avoid concentration of capital in the United States. This is exactly the opposite of China, by the way. China is trying to do exactly the opposite thing. However, just before we dive into understanding exactly what is the big problem and what is currently happening to those banks, if you like this kind of subject, understanding liquidity, how money is created, distributed, and monetary mechanics, we have our Bitcoin intelligence report, and you can also find not only monetary mechanics but our on-chain analysis as well. So this is our brand new Substack, and you can find all links and descriptions below. So this concept is something that I show a lot in our videos, which is capital and collateral. So this is how banks generate credit worldwide. So you need to post a collateral, and basically you're selling it for a price to repurchase for a slightly higher price, which is basically the interest. That's how banks operate, and they generate 80% of worldwide credit this way. So the most important thing for the system, which we call a repo, which stands for repurchasing agreements, is that the collateral is trustworthy. It has to be liquid. It has to be available everywhere you need it, and the most neutral as possible. So the pristine collateral, so to speak, would be US Treasuries, but it can also provide repo in more ways. You're able to do that with CLOs, with corporate bonds, with stocks. It's also possible, and so on. But you can also use mortgage-backed securities, which is what happens a lot within the community bank network. However, there are two big problems that actually create obstacles to those banks to thrive or even survive nowadays. First off is the first one is in 2008, we did have many regulations that are in place, like the SLR, RWA, and many other acronyms. I don't have time to explain them here, but those actually limit a lot the capacity of those banks to lend to the real economy, to lend to small businesses, to allow them to grow, or even to create businesses through a business plan, which is not the case anymore. So most banks, they just try to survive or thrive through arbitrage plays with the Fed or with other institutions outside of the US and the Eurodollar system. So, but even though repo has been the standard for credit, we do have a huge problem. There is not enough collateral for everyone. So if we got like 100% of all credit or repo related transactions, only 60 or 70% of them are properly backed. So we don't know exactly that amount because it's a huge black hole, as Jeff Snyder from Eurodollar University would say. But the main idea here is that many banks, they have no other choice than to borrow collateral from somebody else. And that collateral, in order to transact on repo, to get credit, so you borrow against a collateral that might be used already in another repo transaction. So this is what we call a collateral multiplier. And of course, this increases the risk, but sometimes it's even worse. Sometimes you may have a security that you think it's actually backed, but that security was uh, maybe doesn't have that value anymore because of a problem on a mortgage-backed security or of a commercial paper, or maybe another kind of a commercial building mortgage-backed security. So these can become a little shady, and then you have the problem of a huge hole that is built up in a bank's balance sheet. And when you add up the whole regulation from 2008. So you have both kicking in at the same time. So you have to have a lot of reserves to back your liabilities, but the assets you think you have, you actually don't. So then you become on a catch up. On a huge catch-up scenario where some banks are not able to survive. That's where intervention is required from the Fed, required, quote unquote, required on this kind of system. But there's a silver lining. So Scott Bessent is actually, for the very first time, a Treasury Secretary, would actively and explicitly talk about this very subject, on how important community banking is, and try to actually get them out of those handcuffs, so to speak, if you consider regulation like that, because they're over tightening and preventing those institutions to actually lend to the real economy, to real people, to small businesses that are going to thrive. And he also claims how important it is for a community bank, because they really understand their client. They know what every single region, if you are in the middle of North Dakota and you have a bank over there, they know their clients way more than JP Morgan, for example. So to try to bring that capillarity back to the market is one of the focuses. So on one end, you have the whole narrative that this is going to just spread out and absolutely collapse, which is not really the case. We don't see too many of those stress signals. Even though they are increased, it doesn't mean that it's a total collapse. But on the other hand, it's not a given that this plan will actually work to redo everything. So this constant tension actually creates the market's expectation on what it's actually going to happen, if it's going to be widespread or not, and thus influencing the markets and also liquidity. And as of today, S&P 500, everything just up. Even Bitcoin is on an uptrend at this very moment as we record. So let's see what happens. But this is pretty interesting. So it's just to be aware of the mechanics involved, but any doomsayers now should be taken with a grain of salt. Even though we see those stress signals, it doesn't mean that there is no action happening over there. So it's going to be interesting to see what happens next. And again, we're always going to be tracking those monetary mechanics movements. All right. I hope this was helpful, and see you in the next video.